Welcome to this deep dive, into the world of Charlie Munger. We're going to explore his unique approach to investing, pulling wisdom from the book, Charlie Munger, The Complete Investor, which you've shared with us. This isn't just about stocks and bonds, though. We're aiming to uncover how Munger's thinking can sharpen any decision you make.
Munger's known for cutting through the noise and getting to the core of things, and we're going to try to do the same here.
Exactly. What I find fascinating is that Munger didn't start as a Wall Street whiz kid. Math meteorology during World War II law. Those were his early pursuits. It wasn't the typical path to becoming an investment legend.
Yeah, his multidisciplinary background is key. It's like he built this mental toolkit from different fields. He once said, "You're not going to get very far in life if you know only one or two subjects very well. You must have models in your head."
So it's more than just being smart. It's about having these different lenses to look through when you're analyzing a situation.
That's spot on. And this brings us to a concept Munger returns to time and again: the importance of knowing your limits. He even quotes Confucius on this, saying, "Real knowledge is knowing the extent of one's ignorance."
That's humbling to say the least. If a tightrope walker gets cocky and forgets their limitations, it's game over. Do you think that translates to investing?
Absolutely. Think about it. If you're overconfident in an area you don't truly understand, you're setting yourself up for a fall. It's like that story of the investor and the frog speculator. Remember that one?
Yeah, the investor calmly waits for the perfect opportunity. It's like a frog waiting to snatch its prey.
Exactly. Munger uses that story to emphasize the importance of patience and decisive action. Wait for the obvious bet, the no-brainer opportunity, and then act decisively. He even ties this back to baseball. No called strikes in investing, so you only swing at the pitches you know you can hit.
This idea of waiting for the obvious bet really shines when we consider Munger's advice for most investors, especially those who might not have the time to scrutinize every single business index funds come to mind.
That's right. He's very clear. Index funds are a solid choice for those who don't have a deep understanding of investing fundamentals and have a long-term horizon. He calls this type of investor the know-nothing investor.
But he's not being derogatory, right?
Not at all. It's more about acknowledging that not everyone can or should devote themselves to active investing. And there's a good reason for that. Munger highlights this concept called the croupier's take, which basically means
the house always wins.
Exactly. In this case, the house is the collective fees that all active investors pay. Even if the market goes up, those fees eat into your returns. So statistically, half of all active investors will underperform the market average and might even end up with what Munger calls unexciting to lousy returns.
Oh, that's a tough pill to swallow.
It is, and that's why Munger stresses the importance of honesty. Before you even consider active investing, you need to ask yourself, do I have the time, the temperament, and the discipline to succeed?
So that's just about intelligence. It's about your personality and how you handle risk and uncertainty.
Precisely. And if the answer to those questions is no, sticking with index funds is not only perfectly valid, it might be the more rational choice, especially if active investing seems like too much of a headache.
I like how Munger even suggests that if you do want to try active investing, keep it small. Treat it like a fun side project, and keep the majority of your money in index funds for stability. And this brings up another important point. Don't outsource your thinking, especially for complex decisions like this.
He's adamant about taking ownership of your decisions, especially when it comes to your money. If you're considering active investing, you need to be comfortable with the research and analysis involved. You can't just blindly follow someone else's picks. It all goes back to that tightrope walker analogy. Being aware of your limits is crucial.
This segues nicely into another distinction Munger makes, which is the difference between investing and speculating.
He's very clear about this. Investing focuses on the long-term performance of an asset, while speculation is all about betting on short-term price movements. It's like playing two completely different games. Munger even says that if you're a speculator, you're commonly focusing on the price of something rather than the underlying asset itself.
So if you're constantly chasing the next hot stock tip, are you really investing or are you just gambling?
That's the question Munger wants you to ask yourself. He believes that understanding this difference is crucial for long-term success. Buffett echoes this sentiment, saying, "The most important quality for an investor is temperament, not intellect." You need a temperament that neither derives great pleasure from being with the crowd or against the crowd. Focusing on the wrong game, as Buffett points out, can hurt your returns in the long run.
Which is why we should probably talk about the oil prospector in hell, right?
Ah, yes, Munger's classic story about the prospector who, upon hearing a rumor of oil in hell, decides to join the Klong heading there, just in case. It sounds funny, but it highlights a dangerous tendency we all have.
To follow the crowd even when it doesn't make sense.
Exactly. The oil prospector story is a cautionary tale about the dangers of herd mentality and blindly following market trends. Munger and Buffett are both skeptical of market forecasts. They believe that the best way to succeed is to focus on understanding individual businesses deeply.
So it's less about predicting the future and more about analyzing the present.
That's the core of Munger's approach. He calls it private market value, or PMV. He believes that you should understand a business so well that you know what a knowledgeable industrialist would be willing to pay for it. It goes beyond just looking at the stock price. It involves scrutinizing the company's assets, liabilities, cash flow, and comparing those to public valuations and transaction data.
It's like putting on the hat of someone who's not just playing the stock market, but who's actually in the business of buying and selling companies, right?
Exactly. And this ties in nicely with another key Munger concept, margin of safety. He believes that buying assets below their intrinsic value, that knowledgeable industrialist price we were talking about, provides a cushion against errors.
That's where patience comes back into play, right? Because finding those opportunities often takes time and discipline.
Absolutely. Munger recognizes that everyone makes mistakes. So having that margin of safety built in can protect you from the consequences of those inevitable errors.
It's like having a financial safety net to catch you if you stumble.
Precisely. And this brings us back to Munger's lattice work of mental models, which helps him avoid those stumbles in the first place.
Okay, let's dive into that a bit deeper. Herbert Simon described mental models as a set of tools that experienced decision makers use to understand and respond to situations. Is that how Munger uses them?
Yes. He draws on insights from fields like economics, psychology, incentives, even physics and geometry to make better decisions. It's like having a multifaceted perspective rather than a one-dimensional view.
So it's about seeing the world through multiple lenses rather than just one. That reminds me of how Munger explains seemingly illogical price increases.
It's a great example. He points out that things like bribery signaling and social proof can influence prices in ways that traditional economic models don't always account for.
So there's more to pricing than just supply and demand.
Absolutely. Munger encourages us to look beyond the obvious and consider the less intuitive forces at play. And sometimes those forces are driven by self-interest, as we see in Munger's rather shocking example of incentive-caused bias in the mutual fund industry.
You're talking about that example where mutual fund managers basically bribe brokers to sell their products by increasing commissions.
That's the one. It's a stark reminder that incentives drive behavior even when it leads to unethical outcomes. Munger calls this the iron rule of nature. You get what you reward for.
It makes you wonder how often we see this playing out in other areas of our lives where incentives are misaligned, creating unintended consequences.
It's a question worth pondering.
Now, on a more positive note, one of my favorite Munger quotes is about becoming a learning machine and going to bed wiser each night.
It's a great reminder that learning is a lifelong journey, and the more we learn, the better equipped we are to make sound decisions.
And Munger's own life is a testament to this. His multidisciplinary approach has not only made him incredibly wealthy, but has also enriched his life in countless ways.
He's a true Renaissance man, and his example inspires us to broaden our horizons and embrace the power of continuous learning.
And on the flip side of embracing knowledge, Munger warns against unnecessary complexity, especially in business. He once said, "Where complexity lies, fraud and mistakes abound."
He favors simplicity and clarity, believing that it leads to better decisions and fewer errors. Buffett echoes this sentiment with his rule about explaining your mistakes. If you can't explain it, the business was too complex for you.
It makes you wonder if we sometimes create complexity where it doesn't need to exist, making things harder than they have to be.
It's a trap we can all fall into.
Now, this emphasis on simplicity is especially important when you consider the reality of investing. It's often a zero-sum game.
For one person to win, another must lose. This highlights the challenge of finding truly undervalued assets and emphasizes the need for a clear and rational approach.
Speaking of clear and rational thinking, there's another Munger quote that comes to mind. It's very hard to get a man to believe non-X when his way of making a living requires him to believe X.
It's a profound insight into human nature. We tend to believe what benefits us, even if it contradicts evidence or logic. It's what Munger calls incentive-caused bias, and it can be incredibly powerful.
It reminds me of that example we talked about earlier with mutual fund managers justifying their high fees. Their beliefs align perfectly with their self-interest, even if it's at the expense of their clients.
It's a powerful reminder to examine our own beliefs and how they might be shaped by what we stand to gain, even subconsciously.
It's easy to point fingers at others, but are we being honest with ourselves about our own biases?
That's the question Munger wants us to ask ourselves.
Now, this idea of challenging our assumptions is especially important when we're dealing with experts and authority figures.
That's right, because even experts can be wrong, and sometimes those who appear to be authorities aren't as knowledgeable as they seem.
I remember that chilling example Munger gives about the pilot and the co-pilot in a flight simulator.
The fact that 25% of co-pilots failed to prevent a crash when the pilot made an obvious error is a testament to the power of authority, even when it's clearly misplaced.
It makes sense, though. When faced with uncertainty, we tend to defer to those we perceive as experts, even when our gut tells us something is wrong.
And unfortunately, this human tendency is often exploited.
Like those stock promoters with their fancy suits and flashy cars. They're masters at projecting an aura of authority and expertise.
Exactly. And that's why critical thinking is so vital. We can't just blindly accept what we're told, especially when it comes to our money. We need to be skeptical, ask tough questions, and do our own research.
It's about taking ownership of our decisions and not relying on others to think for us.
Yeah.
Munger has a term for when these psychological tendencies combine to create really bad decisions. Lollapalooza effects.
It's not just one bias at play, it's a whole cocktail of them working together to amplify our irrationality.
And he gives some great examples like the 2007 financial crisis, the dot-com bubble, even Tupperware parties.
All situations where a combination of psychological factors led people to make decisions that, in hindsight, seem completely crazy.
It's both fascinating and scary to think about how easily we can be manipulated by these forces, even when we think we're being rational.
It's why Munger stresses the importance of understanding these biases and developing strategies to mitigate their impact.
So it's not just about being smart. It's about being aware of our own psychological weaknesses and developing mental defenses against them.
Exactly. And this brings us to another interesting observation from Munger, the reason-respecting tendency.
You mean that idea that even nonsensical reasons can increase compliance? It reminds me of that example of cutting in line at the copier and saying, I have to make copies? It's absurd, but it often works.
It's a classic example of how we tend to comply with requests, even when the reasons given are completely illogical. And this tendency is often exploited by those who want to manipulate us.
Like scam artists who use elaborate, meaningless reasons to justify their schemes.
Exactly. And that's why it's so important to be critical of the reasons we're given, even when they sound plausible. We can waste so much time and energy on things that ultimately mean nothing.
So sometimes the best way to make a good decision is to simply step back and ask ourselves, does this even make sense?
Precisely. It's about cutting through the noise and getting to the heart of the matter.
And sometimes, as Munger shows us with the story of the investment banker and the carpenter, the simplest answer is the best one.
That's a great story. It highlights the contrast between overthinking and simple wisdom. The investment banker, with all his complex financial models, is stumped by the carpenter's straightforward riddles.
It's a reminder to avoid overcomplicating things and to focus on the essential truths.
And this brings us to the evolution of Munger and Buffett's investment philosophy, which started with Benjamin Graham's classic cigar butt approach.
Buying those deeply undervalued, almost dead businesses, hoping to squeeze out one last puff of profit.
That's right. But over time, they've come to appreciate the importance of business quality, even if it means paying a slightly higher price.
The See's Candies example is a great illustration of this shift. They saw that even though See's was already profitable, they could raise prices without hurting demand, a clear sign of a truly exceptional business.
Sometimes paying a fair price for a great business is the best deal you can make.
And that's where the concept of the moat comes in. It's like a castle's defense system, but for businesses.
Exactly. It's that sustainable competitive advantage that protects a company's profits from competitors.
And Munger and Buffett have identified 4 main types of moats: supply side, demand side, brand, and regulation.
Let's take a closer look at each of these using real-world examples that you might be familiar with.
That sounds great. I'm ready to dig into those moats. Okay, you mentioned 4 types of moats. Supply side was the first one. What exactly does that mean for a business, and how does it protect their profits?
A supply-side moat comes down to efficiency. Companies with this type of moat can produce and deliver their goods or services more cheaply than their rivals.
So it's like having a cost advantage built right into their business model.
Exactly. Think about Costco. They've mastered the art of supply chain management and operate on razor-thin margins. Their size allows them to negotiate incredible deals with suppliers, which they pass on to their members.
That's a good example.
Yeah.
I've always been impressed by how Costco seems to offer lower prices than almost anyone else.
It's their supply-side moat in action. It makes it very tough for smaller competitors to match their pricing without sacrificing profitability. Munger even uses a simple geometry analogy to illustrate this. Imagine building a large circular tank. As you increase the dimensions, you can hold a lot more volume per unit area of steel used in construction.
So as you scale up, your efficiency increases. It's like getting more bang for your buck.
That's the essence of a supply-side moat. Another classic example is the early days of television advertising. Large companies like Procter & Gamble could afford the expensive costs of network television because they were selling so many different products.
Smaller companies simply couldn't compete, even if their products were good.
That's right. The cost of reaching a large audience was prohibitive for them. So even back then, scale created a powerful advantage.
What about the second type of moat, the demand-side moat? I think those are also called network effects, right?
Exactly. Network effects occur when a product or service becomes more valuable as more people use it. It's a powerful dynamic. Think about platforms like Facebook or eBay. They're not just websites. They're networks of users, and the more users they have, the more attractive they become to new users.
It creates a kind of snowball effect.
Yes, it's a virtuous cycle that makes it very difficult for competitors to break an American Express, which is a company in Berkshire Hathaway's portfolio has benefited greatly from network effects.
I can see how that would work. The more merchants accept their cards, the more valuable the card becomes to users. And the more users there are, the more merchants want to accept it.
Exactly. It's a self-reinforcing loop that creates incredible value for both sides of the network. And it's why companies with strong network effects tend to become incredibly dominant.
And then there's the power of brands, which is the third type of moat.
Brands create an emotional connection with consumers that goes beyond just the functional benefits of a product. Munger and Buffett for a long time undervalued the strength of brands until they bought See's candies.
See's was like a light bulb moment for them.
It was. See's showed them that a strong brand allows you to charge a premium price without sacrificing demand. People were willing to pay a little extra for See's chocolates because of the company's reputation for quality, tradition, and even nostalgia.
It's not just chocolate, it's an experience.
Exactly. And another prime example of brand power, of course, is Coca-Cola.
They've built a global empire on sugary water. It's incredible.
Whoa. It's a testament to the power of consistent marketing, a memorable product, and a brand that resonates with people across cultures. Building that kind of brand power takes time, but it creates a moat that's very difficult to overcome. Think of all the generic cola brands that have tried to compete with Coke. How many can you name?
Probably none, to be honest. It's like trying to compete with Kleenex and facial tissues or Xerox and copying.
Exactly. And that brings us to the fourth type of moat, which is regulation. This one's a bit different from the others, and it doesn't always benefit consumers.
How so?
Sometimes government regulations can create barriers to entry that make it very difficult for new businesses to compete with existing ones. It can almost create a kind of artificial monopoly or oligopoly.
I'm guessing this isn't something Munger and Buffett actively seek out, right? It seems a bit ethically murky.
It is. They recognize that regulation can cut both ways. Sometimes it's necessary to protect consumers or ensure fair competition, but other times it can be used to stifle innovation and benefit special interests.
So it's something to be aware of and to analyze carefully when you're evaluating a business.
Absolutely. Munger even points out that certain industries like banking have become so complex that regulators are often captured by the industry they're supposed to be overseeing.
So they end up protecting the bank's interests rather than the public's.
It's a risk, and Munger uses the example of professional guilds like lawyers who have historically used regulation to limit the supply of lawyers and keep their fees high.
That's interesting. So sometimes regulation can actually act as a barrier to competition rather than a promoter of it. What about a real-world example from Berkshire Hathaway's portfolio?
Moody's, the credit rating agency, is a great example. They benefited from regulations that essentially made their ratings mandatory for certain types of investments.
So they had a kind of captive market.
Exactly. Now, it's important to note that not all regulation is bad. Sometimes it serves a valuable purpose. But Munger's point is that it's a double-edged sword that can be used for good or ill.
Okay, so we've covered the four types of moats. I'm curious to hear more about Berkshire Hathaway itself. What are some of the key advantages that have allowed them to be so successful?
One of the most significant is their structure as an internal capital market.
I remember you mentioning this earlier. It's like a mini Wall Street operating within Berkshire itself.
Precisely. When a Berkshire company like See's Candies generates excess cash, Buffett and Munger can allocate that capital to other Berkshire companies without having to pay taxes on those transfers.
That's a huge advantage over a typical company, which would have to pay taxes every time it moved money around.
It allows Berkshire to compound their returns at an accelerated rate. Munger often gives the example of the difference between paying taxes once at the end of a 30-year investment period versus paying them annually. That seemingly small difference compounds to a massive advantage over time. It's one of the secrets to Berkshire's long-term success.
And their approach to management is also pretty unique, right?
It is. Berkshire is known for its decentralized structure. They hire exceptional managers, give them autonomy, and trust them to run their businesses as they see fit.
It sounds like a manager's dream.
It can be, and it's a key part of their strategy. They found that giving their managers freedom and responsibility leads to better decisions and outcomes.
It's the opposite of micromanagement.
Exactly. And this trust is based on a shared commitment to integrity, which Munger considers just as important as talent.
So it's not just about being smart. It's about being ethical.
That's right. Munger believes that integrity is not only the right thing to do, it's also good for business. When you can trust your managers to act with integrity, you don't need to spend as much time and resources on oversight and compliance. It streamlines decision-making and creates a more efficient organization.
It makes sense. Trust is a powerful lubricant for any business.
And this culture of trust extends to how they acquire businesses. Many business owners prefer to sell to Berkshire because they know that Berkshire will allow them to continue running their businesses and won't interfere with their operations.
So it's not just about buying a business, it's about acquiring the talent and expertise that comes with it.
Exactly. It's a long-term partnership. They're not looking to flip businesses or load them up with debt like some private equity firms.
They're looking to add companies to their family.
That's a good way to put it.
Now, you mentioned that Berkshire has permanent capital. What exactly does that mean, and how does it give them an advantage?
It means they don't have to worry about investors redeeming their shares like a mutual fund does. This gives them a tremendous advantage because it allows them to be patient and ride out market fluctuations.
It's like having a financial cushion that allows them to be greedy when others are fearful.
That's a great way to put it. Bruce Berkowitz, another successful value investor, describes cash as financial Valium. It allows you to stay calm and rational during times of market turmoil.
So Berkshire can afford to wait for the right opportunities, and they don't feel pressured to invest just because they have cash on hand.
Exactly. And this long-term perspective has been a key factor in their success. But even with all these advantages, Berkshire faces challenges, especially as the company has grown to such an enormous size.
They're a victim of their own success.
In a way, yes. Finding investments that meet their criteria has become increasingly difficult. They simply have too much money to invest in small companies, and the really great large companies don't come up for sale very often. They have to be incredibly selective.
It's the curse of having too much money to invest. What about the challenges of competing in today's rapidly changing business landscape?
That's another significant challenge. Munger and Buffett have seen firsthand how even the strongest moats can erode over time as competition intensifies and new technologies emerge.
They often use the example of Kodak, which went from dominating the photography market to bankruptcy in a relatively short period of time.
It's a cautionary tale about the dangers of complacency and the importance of adapting to change.
It's almost like a business version of Darwinism. The companies that can't adapt to the changing environment eventually go extinct.
That's a good analogy. And they've witnessed the decline of department stores and big box retailers as online competition has reshaped the retail landscape.
It's a reminder that no business is immune to disruption no matter how successful they are.
That's right.
And it highlights the importance of constantly reassessing competitive landscapes and being willing to adapt.
Now, Munger and Buffett clearly believe that great managers can make a big difference in a business's success, but they also acknowledge how rare those exceptional managers truly are.
They often point to Costco's James Sinegal as a prime example. He built an incredible business based on a culture of customer service and employee loyalty. But they're quick to point out that betting on the quality of the business itself, with its underlying economics and competitive advantages, is generally a safer strategy than relying on finding a superstar manager.
It's like the old adage, bet on the jockey, not the horse.
But sometimes the jockey is so good that it's worth making an exception. Didn't Berkshire acquire a company called Iskar for a premium price because they were so impressed with the management team?
That's right. They recognized that Iskar's management team had built something truly special and were willing to pay a premium for it.
So even the most disciplined investors can be swayed by the human element, especially when they encounter individuals who exhibit exceptional talent and integrity.
And it reinforces that idea that surrounding yourself with the right people is crucial for success.
It's a lesson that applies far beyond the world of business.
Absolutely. It's a fundamental principle for building strong relationships and achieving lasting success in any field. Now let's get back to the nitty-gritty of Berkshire's investment approach.
Okay, I'm ready to dive into that Berkshire math you mentioned earlier. I'm curious to see what makes it so special.
Well, as I mentioned before, it's surprisingly simple, especially when you compare it to the complex financial models that many analysts use. It starts with calculating the past and current owner's earnings of the business.
And that's different from just looking at net income.
It is. Owner's earnings takes into account things like depreciation, capital expenditures, and other factors that affect the actual cash flow that the owner of the business receives. It's a more comprehensive and realistic measure of profitability.
So it's about understanding how much cash the business is actually generating, not just what the accounting statements say.
Exactly. Once they have a good grasp of the owner's earnings, they project a reasonable growth rate for those earnings, being very conservative in their assumptions.
So no pie-in-the-sky projections.
They avoid those like the plague. Then they discount those projected earnings back to their present value using the 30-year U.S. Treasury yield as a discount rate.
So they're using a very low-risk benchmark to compare potential investment returns.
That's right. They're looking for a significant margin of safety, meaning they want to buy businesses at a price that's well below their estimated intrinsic value.
And they're not swayed by metrics like earnings per share, which can be easily manipulated.
Not at all. Their focus is on return on equity, or ROE, which is a more reliable indicator of a business's long-term profitability.
It sounds surprisingly straightforward.
It is, and that's part of its appeal. It avoids unnecessary complexity and focuses on the essential elements of a business's value.
And this aversion to complexity applies to the businesses they invest in as well, right?
Absolutely. If they can't clearly understand the underlying economics of a business, they simply move on.
It's like that old saying, you have to kiss a lot of frogs to find a prince. You're probably looking in the wrong pond.
Exactly. They're not afraid to walk away from deals that seem too good to be true or too hard to figure out.
Now, this emphasis on simplicity and clarity extends to their management philosophy as well.
They believe that the best businesses are often the easiest to understand.
No need to reinvent the wheel, right?
That's right. This focus on simplicity helps them avoid unnecessary risks and mistakes.
It's fascinating how this commitment to clear thinking permeates every aspect of their approach, from investing to management to capital allocation.
It's a testament to their intellectual consistency and their unwavering commitment to finding the right way to do things.
Well, this has been an incredible journey so far. We've covered a lot of ground, but I still have a few more questions.
I'm happy to answer them.
So you're saying it's better to bet on the business, not the jockey, even though great managers are important.
You got it. Finding a truly great manager. It's like finding a diamond in the rough, right? It doesn't happen every day. While a skilled leader can boost a good business, they shouldn't be the main focus.
So investors should prioritize finding those companies with solid fundamentals and those long-lasting competitive advantages, like we talked about earlier.
Definitely. Those are much better indicators of long-term success than just betting on a charismatic CEO, you know? It's like that saying about building a house on solid rock instead of shaky ground, right?
I see. But didn't Berkshire kind of go against that when they bought Iskar?
Oh, that's true. The Iskar deal is a perfect example of when amazing people are worth breaking the rules for Munger and Buffett. They were blown away by the talent and honesty of Iskar's management team, to the point that they paid a premium price for the whole business.
So they knew they were getting something really special, not just the business itself, but the people leading it.
Exactly. It was a once-in-a-blue-moon kind of situation, and they were willing to stretch their usual rules because they saw the potential for creating value over the long haul. It just goes to show you, investing's not only about the numbers, it's also about understanding the people involved.
Okay, let's circle back to that Berkshire math. I'm really curious to hear the details of how they figure out a company's worth.
It all boils down to calculating what they call owner's earnings. It's a better way to measure how profitable a company really is than just looking at their net income, you know?
So you're talking about understanding the actual cash flow the business is making, not just what's on paper in those accounting statements.
Right on the money. Owner's earnings consider things like depreciation, capital expenditures, and other things that can impact the actual cash the owner takes home.
Can you give me a simple example to make that clearer?
Sure. Let's imagine a company that makes, say, widgets. They report a net income of $10 million, but they also had $2 million in depreciation and spent another $3 million on new equipment. So their owner's earnings would actually be $5 million. That's the $10 million income minus the $2 million depreciation, then add back the $3 million they spent on equipment.
Got it. So it's basically adjusting for the fact that some expenses, like depreciation, don't actually mean cash is leaving the business.
Exactly. And those capital expenditures, which are often lumped together on those financial statements, can really change from year to year. So knowing how much they're spending to keep the business running and growing, that's super important.
Okay, so once they've got a handle on these owners' earnings, what do they do next?
Then they project those earnings into the future, being very careful not to be overly optimistic, you see.
No wild guesses or overly optimistic projections then.
They hate those. They go for a reasonable growth rate, usually just a bit higher than inflation, and then they take those future earnings and discount them back to what they're worth today. They use a really conservative rate for this, usually the yield on those 30-year U.S. Treasury bonds.
So basically they're saying if we could get this return without any risk from a government bond, what would we be willing to pay for this business, knowing there are risks and potential for growth?
That's it. And they always look for a nice margin of safety, meaning they want to buy the business for much less than what their calculations say it's worth. They're not settling for just good deals. They want those grand slam deals with extra protection built in.
And they're not swayed by things like earnings per share, which can be misleading, right?
Not a chance. Their focus is on return on equity, or ROE. It's a much better way to see how profitable and efficient a company is over the long haul. They're looking at how well a company uses its shareholders' money to make more money.
This Berkshire math, it sounds pretty simple but effective.
That's the beauty of it. It cuts through the clutter and zeroes in on what truly matters for a business's value. And another thing, they steer clear of businesses with super complicated or uncertain valuations. If they can't wrap their heads around the economics of a business, they walk away.
They don't try to force it or overthink it?
Nope, Munger puts it perfectly. He says, it's remarkable how much long-term advantage people like us have gotten by trying to be consistently not stupid instead of trying to be very intelligent. It makes you think, right?
It really does. We've learned a lot today, from those mental models to those moats, from the importance of integrity and keeping things simple to those tricky psychological traps. Charlie Munger has given us a lot to consider.
His whole approach to investing into life, it's a testament to the power of clear thinking, never stop learning, and sticking to your ethics.
It's been a fascinating journey through the world of Charlie Munger. If you could leave our listeners with one last thought, something to chew on, what would it be?
Munger loves to say, invert. Always invert. Don't just think about how to win, think about how to lose. By figuring out the ways you could fail, you can often find the path to success. It's a powerful mental trick to make better choices in everything you do, not just investing.
Thank you for sharing your insights with us today. It's been an absolute pleasure.
The pleasure was all mine, really.